Hi, I'm Mark King, investment editor at Columbia Threadneedle Investments, and here's what's in my weekly column. In just under 2 weeks' time, the Federal Reserve is expected to raise US interest rates for the second time this year. But in the UK and Europe, rates do not look likely to rise anytime soon. While inflation is rising in Europe and UK, it doesn't appear to be causing central banks any concern against the backdrop of Brexit negotiations. The European Central Bank remains concerned that if it raises interest rates too quickly, it could pose a risk to growth. Despite the recent economic uptick, the Eurozone remains fragile. Move too fast and it could damage the recovery. And in the UK, uncertainty around Brexit undoubtedly continues to contribute to the Bank of England's caution about increasing interest rates. Elsewhere this week, the UK financial services regulator, the Financial Conduct Authority, has announced further reforms to ensure people shop around when buying an annuity. In April 2015, pension savers at and over the age of 55 were granted the freedom to invest, save or spend their pension pot as they saw fit. Previously, most savers have been forced to use most of their pension pot to buy an annuity at retirement, an imposition that many people resented. Since the pension freedoms, sales of annuities, which is an insurance policy that provides an income for life, have fallen substantially. However, for some savers, the certainty annuities offer continues to be attractive. Under the reforms, pension companies and financial advisors will be forced to tell customers how much they could gain by shopping around, rather than simply accepting the quote offered by their pension provider. FCA research had found that the vast majority of savers settle for the quote from their existing pension provider when they're buying an annuity, even though 80% could have done better by shopping around. See you next week.